All right, everyone. It's been some time since I did one of these things, one of these videos, and I figured today is a, good day to do it as ever, um, because today is the day that um, the Fed's going to be coming out with setting the next round of rate, well, what seems to be rate hikes, um, and so. Basically, wanted to do like a little go over of the market and tried to make a projection as to like what like what we may be facing in the market, right? Um, and to kind of maybe take a look at the game plan and furthermore kind of go over the market situation, right? At least on the equity side, and then after that, I'll probably do some other content on like the other markets. So first of all, let's just go ahead and speak about, let's say, like where we are right now. And this time I'll try to make the video short, although I'm not sure that's going to work out. Um, so, um, so basically, as of right now, we are at one and a half to one and a quarter or so of percentage in the Fed fund rate, and so seemingly since given that our inflation rate is quite obviously getting higher, if you have not been living under a rock or haven't watched some of my other videos before, that last time it was, I believe it was 9.1 year to year. Um, and so what this implies is basically, cost of things go up, and if cost of the things go up, well, people don't spend money, and American economy is basically a consumer economy, anywhere between 67 to 70%, if not higher, of that estimated is basically consumer, right? Consumer products. And so basically, what do we have on hand is, um, let me go ahead and save that. Yeah, it's good. And so, um, just go ahead and those are some of the old uh, channels I had before. But anyway, so let's go ahead and kind of basically as the market kind of starts to kind of like act the way it's behaving, and based on our inflation reading, our expectation is basically the Fed to hike up the rates, and to which point that estimated it's going to be anywhere between three and a quarter of a point to almost a full point. Generally speaking, they've been very hawkish. If you look at all the Fed major Fed heads of all the 19 different people on the FOMC meetings, they are more or less all talking about fighting the inflation front, right? Um, and this is not something that seemingly will be going away. And so at this point, what they have to work with is essentially if they have to, beat inflation, well, then we're speaking of doing something drastic, because at this point, it hasn't really been, being really dealt with. Um, and so what that implies is basically that if they keep on jacking up the interest rates, um, it's not likely. It's simply not likely for the market to keep on going up. Now, market moves on expectation. So the expectation, it's like, okay, so the market's going and doing its thing, right? And if the expectation for inflation, let's say they are saying, expectation is 75 basis points, they really did a whole point, and then we have a situation where basically then the market might oversell, or it might sell off because, well, the expectation has to be, the market has to kind of like adjust to the new expectations, right? And so basically, um, what that implies is that any kind of any kind of market moves has to act like the expectations based off of what the Fed will set the standard. And if it's at 75 basis points, and they're going to be jacking interest rates in the future, which is again what the going assumption is, then again, it's not likely the market will be, generally speaking, it's not likely the market, will be going higher. And the reason is pretty simple, and that's because it's tightens financial conditions, because there's simply less money to go around. Because anytime you jack up interest rates, you make cost of business higher, and cost of business goes up higher, then, well, people don't have money. People don't have money, then what do they do? I mean, they don't buy stuff. It causes businesses to shrink their ability, their ability and willingness to lend money, because they want to be more sure of the money that they have, that people are getting, that they'll be paying them off. They're going to be more judicious at that. That money becomes dear, so to speak, right? And given that, um, we kind of have a weird situation where, well, it's not weird. I mean, it should be expected that under the current situation, you also have macro numbers that, the Fed is basing their, so kind of stepping back a little bit, the Fed is basing their uh, what the decision about the rate hikes, or rate cuts, in this case rate hikes, based off of employment numbers. Because employment numbers, if there's a lot of people getting employed, then people buy stuff and there's more money to go around. In other words, that we might be facing more higher inflation. And so this is what they're basing on. Now, the thing with that, that I find kind of interesting is because, well, um, the problem with that is basically that's like the end product, right? It's a lagging indicator rather than a leading indicator. And so what ends up happening is that if you have um, if you're basing that on the employment front, then you have to look at what leads it is like things like PPIs and things of that nature, a producer purchase index. And so because that implies that, if the producers are costing more, that will then be rolled out to the average person, and the average person is, takes more money to buy things, and then bam, you have a problem with the people making buying stuff products, and then companies making money, which then leads into them not hiring as much because they're not making as much money, and on and on and on. So this is not exactly rocket science. Now, um, so that's basically one of those aspects that you have to kind of consider. Now, also at the same time, you also have other kinds of situations that are forming up, right? So you think of housing. The housing market has been basically kind of starting to like get weaker, right? And as the housing market gets weaker, this is basically the most expensive part of a person's portfolio, or asset, right? And so imagine, basically the U.S. economy is kind of like based off of the housing economy, the housing market, because, well, this is basically the value that, the marginal value that you're getting out of, and then you're monetizing that, and financializing that to create more capital, to create essentially more money. What happens if a market takes starts crashing? Well, we have a problem, right? And so we'll go over some of the numbers that are interesting. So basically, what does this all mean? So the macro numbers are looking bad, essentially, right, or getting worse. So you have higher inflation that hasn't that hasn't tapered off. Expectation is also that um, it's not likely to taper off anytime soon. And then on top of that, you have higher interest rates, which still hasn't actually started to work yet. So um, so what gives for the market to keep on going up? And what where based on the macro picture, based on the market internals, based on um, in the interest rates, based on the 2 and the 10 year inversion and the 2 and the 3 year inversion, you know, um, they don't really look good, right? And yeah, so basically then, um, what are you going to be basing on a bullish scenario? And that is really based off of right now technicals, um, which I will go over, right? And that's the case, right? But um, we have to think about if it's technical. I mean, what are technicals? Technicals can override fundamentals in the short term, but it what sets the environment for a market is the fundamentals, right? And technicals act as a entry point. Um, but the thing is that it's not necessarily what It's not like set in stone, right? Now, depending on what so by that I mean, by set in stone, I mean like if a market has certain kind of fundamental bias, but the technicals come in, the market might not move along with the fundamentals, but it should adjust itself along with the fundamentals. Even the short term technicals might override them. Based off of this, think of like um, also. Oh, by the way, you have the dollar that's just keeps on getting stronger and stronger. Um, and with even though obviously there's fluctuations daily, right? Um, Still an uptrend, but more importantly, the foreign markets are not going to be doing any good, for some time, right? I mean, even if they jack up the interest rates in the ECB, they do only do like basis point, like quarter of a point, whereas the stateside is like three-quarter of a point, right? Stuff like that. In other words, they're not really hiking as much as we're doing here. Um, yeah. So basically, um, those are like again reasons to doubt to what extent that um, we will have a market bounce, and if it does have a bounce, um, it's likely that it's not a serious bounce, right? Okay, so so basically then, um, the case why someone would say like, okay, we might have also bullish markets because, and this is something that I've heard quite a bit on TV, is that, well, inflation will peak because again the whole point is inflation, right? Inflation will peak, generally speaking, when the spike they tend to come down. Well, yes, but they tend to come down like to 2%, right? I mean, if the Fed's goal is to keep inflation at 2%, I mean, the problem with that is that it's not likely to come down to 2%. And if they're not likely to come down to 2%, well, they have to fight, even if they fight inflation, let's say at 2%, and they want to keep like um, kind of a real rate of like 0.5% or like 50 basis points, they would have to jack up the interest rates at like to 2.5, right? The terminal rate. So if that's the case, then, well, I mean, clearly they probably will not be going up to 9.5, right? But again, the whole point being that in order to fight inflation, they have to jack it up, and inflation is not just going to come down to like 2% tomorrow. Even if it does, I believe like the markets are pricing in like um, something like 3 to 5%. I get a look. I think it's like something like 4% in end of 2023. Um, and so that's again another one of those like fundamental problems. You're seeing one of the reasons also is because you're seeing like revisions, right? If you think of like earnings revisions, things like that, Walmart came out with even before their earnings that they have overstock of inventory because they haven't been able to sell as much, and so they're expecting 10 to 20% already before the earnings, like revision down. And remember, Walmart is a big company. I mean, I think it is like the biggest employer in America besides our beautiful government. Um, and so the point is that like there's again a lot of macros that are going against a bullish market, right? Um, Now again, one thing is technically speaking, it looks at least in the short term pretty good. However, you have to always understand think that in a bear market, you know, you can get significant upside, right? And usually in bear markets, the the rebound can be really violent and they can go up really high real fast. But they usually tend to go back down and take their rightful place as just a short term, generally speaking, short term rebound from a very uh, you know from a bear market, right? Now, one of those things that is kind of interesting is that when the market went down, we had an absolute low at 36.16 on like early or mid whatever June. um, the market went down, but one of the and there was quite a bit of like downside move. I think something like 98%, 2 out of 3 days. Like 2 days in a out of a 3 day range. It was like exactly, I believe, like on the low, which was, let's see, the 16th, in the same basically early in the week that they had like basically 3 days in a row where there was over 90% downside, negative volume, and also a 2 days where in between the midday, the first of the third day and the third of the third day, uh, the volume was like 97% downside, right? And so that indicates that there's quite a, like there's a bit of a down move, or let's say like, panic sellout, right? Now, one of the funny part is that in a bear market, though, the panic sellout generally don't look like this, right? Because what happens is that, let's say, like if you have a market that kind of, if this market crashed from here, right? In other words, they're basing the downside and then they have a panic sellout. And generally speaking, that downside move will be sustained and then we'll have like a really long, like a spike to the downside, right? And then it kind of comes up, and then what it does, it bases around at a certain level and just takes forever to base, right? And the prices internally doesn't move as much. You don't have the same kind of dynamic here. Now, granted, the market did go down quite a bit, right? Obviously, 10% from 41.75 down to like 36.16, well, more than 10%. But the problem with that is that it wasn't like basing at a lower point where it just got out of bed and just fell down. It just fell down from the latest high, right? Intermediate or pivot high. Uh, the and so therefore this does not look like a capitulation type of move, right? And then the prices are kind of like really moving up or down every day. Like it's quite a, they're making big swings intraday, but at the same time they don't really take out any kind of major levels, right? And you can see that we only took the levels out here, which is kind of, if you're bullish, that's a good sign. But my concern is that that's just a head fake. And again, it's a bear market move. We don't really have a this move is not really a major move, or in immediate terms a strong move to the upside unless it breaks 41.74. We're still stuck in this range. Okay, it has to break this range, and so there has to be a new pivot high um, to to make us believe that there's a good bit of strength. And so our bias, the strength of the market has changed or is changing. Ultimately, at the end of the day, it has to go up to 48, 19, 18 for us to and break it for us to be in a new bull trend. However, though, if it is able to break 41.75 with good strength, that means that in the medium term, we should expect if this is a bear market to come, test it and go down, or B, if it does break it with strength, well, our summer vacation, summer rally that I've been saying we will be getting, well, that's we got our summer rally, and it's more than a summer rally then. Now, this is again one of those things where um, all throughout the year, a lot of fund flows have been actually positive. In other words, that a lot of funds have been getting money invested, right? So therefore, essentially, the big people haven't really, or people with money, they haven't tapped out yet. So if this is a bear market, in fact, this does look like a bear market. If not a recession, which I believe we are in a recession, or at least a light recession, based on all the macro numbers. Um, well, basically, people again haven't sold out. Weak money haven't sold out, and we haven't seen some kind of capitulation, because that's usually capitulation. That's what happens when you find capitulation points. Also, it's something interesting is that if you look at last Friday's move, and it wasn't a very important week because the market really moved. It really went up and was on a tear, right? Um, and the market sold off. But something that was interesting was that you would expect on Friday, you'd expect on on a big move that there will be more people trading, right? Also before Fed and the GDP numbers, consumer index numbers, all these things are coming in. So one of the funny things is there was not a lot of volume. And if you look at Friday and the fact that the market went down, we know that on that day, based off of again my experience, or usually what generally happens is that people are closing out their trades and basically unwinding them, right, flattening them. In other words, that they're going. In this case, they're basically closing out their longs because they've been long, and so traders are not taking the weekend risk, and then boom, they close it out. But since that there wasn't a lot of as much volume as you expect, it was like definitely lower, significantly lower than the average. Um, well, not significantly, but I think that was like 20%, 25%, which is, I mean, it's decent. But the thing is, this is not like an everyday move, right? I mean, you would expect more. Again, with the dates, this is a very important time. We have all these earnings coming out. Um, so why, what's happening there, right? And the reason there was low volume and people, it went down as fast as hard it did is because basically there's retailers, right? Um, and the people who were basically taking the opposite side, the buyers had to be, well, the small mom and pops. And so that's the same case. If you look at the volume on the previous days, they've been kind of tapering, right? And so the volume now is coming in, low volume, summertime. You know, you get the gist. It's a lot of mom and pop types. So momentum, from that perspective, is lower. It's a little bit of insight, based on my experience. Um, like this is what used to happen. Like when I was on the institutional desk. I'm not going to say where we used to work at, but you basically this is of a trend that you see. Um, so yeah, so back to the earnings report. So earnings report mostly has been okay to let's say not that okay. But some of the earnings, again, the revisions are slowly trickling in, and this is one of those things that we have said before: is that check out for the revisions. That what matters more. And the revisions, like for example, again, Walmart lowering the revision to the downside is because, well, if, people are not if they're not selling their stuff, that means the people who go to Walmart, which is the lower end of the socioeconomic class or strata, that they don't have enough money to spend on consumer items, right? Not a good sign. Now Costco's doing well, which goes to show that basically it's the lower end of the scale that people are not spending money, right? That they're hurting. Something like 40, depending on the week that you look at, 40 to 50% of the people in America have less than $1,000 in the bank. Um, so this inflation thing is really hurting them. And so when we have a recession and or bear market, those are the type of businesses and places that we're seeing getting the most affected. Um, but simultaneously, the housing market is now getting affected, right? With housing market getting affected and all the rich boomers are getting affected, then we have a problem with that. Um, you know, uh, on the upper end now, if people have less money, maybe Costco is in like middle class, upper middle class tier. But in the upper end, if people with assets are, they're getting pounded, what then, right? So that takes away a good percentage of the capital that would have been circulating out of it. And this is again, we kind of going back to hiking interest rates. If interest rates go higher, there's not a whole lot of historical proofs where we can say, well, the market was doing really well on a consistent basis in spite of like jacking up interest rates. Um, Also, if the GDP numbers are bad, the numbers are, let's look at some of the basics. By the way, this is not a good time to trade. I mean, you can obviously, but not necessarily a good time to trade. Um, when we're speaking of in market in this kind of a situation, right? Um, because we don't simply know like where it might go. We want the market to kind of prove itself, right? And market can easily go up or go down. I mean, if you have a bigger outlook, it's one thing. I'm talking about like intraday, maybe to intermediate, because um, it's best to, at least if you have a position, to deleverage yourself to the extent that you don't put a big position, or if you do, have some hedge. So that's it. Let's look at some of the numbers, and um, I had a few of the things I was going to talk about, but man, you start to go on a tangent and you forget everything. So let's look at some of the numbers, and okay, so new house sales, and this is what I was saying, is the housing market is starting to come apart. Um, let's look here. Okay, so interesting thing here to look at is basically NAHB housing market index, which was last was 55%. It was before then it was 67%. That was also the um, expectation was actually 67% too. Now, what was interesting is because this is, people look at Case-Shiller price index and stuff like that, but that's the end result, right? What matters is basically, the the kind of like the leading, data to look at for housing, and that's basically where essentially housing builders and housing they're projecting their business conditions in the future, and if 50% are positive compared to what is supposed to be 67%, then we have a problem. We should see some kind of a down, at least um, lower performance in about 6 months or so, right? And so This is also coinciding with lower amount of housing starts, building permits. Besides, houses that are getting stuck on the. I guess I'll do a different video about that. Gonna go more in depth. There might be some trading opportunities there. Um, and so those are the kind of things we're looking at: pending house sales, new house. You can see they're all negative numbers. Um, and where the hell is mortgage rates? There you go, mortgage rates. Okay. This is one of those things that are affecting it because again, more with higher inflation, with higher interest rates, yeah, higher mortgage rates. But there's also the other side of it of higher cost of making houses, higher lumber cost and things of that nature. That's basically low, um, also pushing prices down. So you have higher cost of building a house, you have higher interest rates, right? So there's different modalities of basically lowering the house, housing. Um, just simply less demand, which causes a downturn in housing prices in the first place. Which basically also remember that people are refinancing the houses. Refinances has gone down, like really taken a hit, right? Um, and so this is one of those other things that are affecting it. Some of the numbers we have to take a look at is obviously today is Fed interest rate decision. Oh, it looks like it's two. Oh, that came out already. 2.5%. Okay, so 2.5%. So let's see the conference. You know what? He's gonna talk about. Oh, I got updated real quick. I thought it was. So basically, let's see what he talks about because depending on what his projection is, then we have to take a look at and market maybe pricing something in there. Now, what will happen with the market? Something also important to understand is that market could also have a. Right now, you can see the. I bet you that yeah, it's really fluctuating. Did a hard damn 30 point up down, right? But what's important to also kind of keep in mind is markets now waiting for like what Powell's going to say. Now, what's also to keep important? Oh, look at that also, right? Um, it's an important level. I'm not gonna go over the intraday levels like this is not like trading average trading day so like I've done in the past. But what's important to keep in note is that you might even see something like um, short covering, right? Like a short squeeze type of situation. Is because if the market, based on what Powell says, now Powell says that we can look, we see good things and we're gonna keep lower it maybe 50 points, whereas the market was expecting something a different number. Well, then what might happen is that it might go up a little bit more, right? Depending on where it goes. And if it does go up, it can, if there's a lot of shorts, and we know there's a lot of shorts because we're in a bear market, this happens all the time where it triggers basically all the other shorts to cover their shorts. And then all of a sudden, market just shoots up again. That's, we could have a situation like that, which looks like, oh, in a bull market, when in fact it's a trap, right? And because the fundamentals has, again, really changed. Um, and and yeah, so the rates are inverted, right? The two year and the 10 years. I guess since we're all waiting for what Powell says, I'm just gonna maybe do this a little longer than I thought. So let's see. Okay. All right. So let's take a look at um, interest rates differential. Okay, 10 and 20. Right. So the 10 and 20 again, it's in the negative territory, right? And what's more important is that It's what the hell? Come on. Okay. Okay. What's more important that it keeps on staying there, right? So now this is where you have a situation where this shows that the financial conditions are tight, so to speak, because the banks don't have a harder time to make money because um, uh, basically, like um, I mean, if you imagine like the long term, they're lending out short term and buying long term, right, to kind of make their returns, but now they can't because, well, well, like they can't, right, because it's inverted now, the 2 and the 10 years. Now, this doesn't in of itself again mean a lot unless um, unless basically, you have a situation where it keeps on. It's all about environment, right? If this keeps on being like this for some time, and with that, you have other kind of um, patterns and macros and things like that coming into play. Well, that tells us that our overall, it tells us like what kind of a situation we're in the big picture, right? Short-term things might happen, right? But you have to kind of discount that. Um, and more, and also you got to take a look at the 3 month 10 year, right? And that's something that most people don't look at, but that has also been, and that's actually probably more important, is because that goes to show the difference between the long term and also like cash basically, um, and even that has, as you can see, been tanking, right? Again, that's probably the more important number to take a look at. Again, that's overall not a good sign. You have China that's still kind of going through, the what was a zero COVID policy. So still things are still kind of gummed up over there. You have the Ukraine situation. You have the energy situation in Europe, right? And everyone's kind of in the same boat. Everyone's trying to fight off recession or really slow down of the economy. So again, all in all, that doesn't sound good. So what's the good side? The good side, someone might say, is that technically in the market looks good, right? And let's just say I kind of agree with that, especially in the short term. But let's take a look. Okay, as we said, um, and this was our expectation, was in fact the market to kind of have a uh, summer rally, and that's what it's doing. Now it's depends. Now, does this over like shoot our expectation for summer rally? July is the one of the best months in the year, and from August to December, usually August to November, right? Fireworks happen, so to speak. Um, October is kind of like, I think, the most volatile month in the year. Usually, we have we have all this like macro situation. We've just been through COVID. We've been through, we've gone through this war. We've been through, I mean, you name it, right? QE, right? And now QT, right? Quantitative easing and quantitative tightening. Uh, if the people who were buying and keeping the market up was the Feds, basically through BlackRock, and if they take that away, because remember, why were they doing that? Is because to prop up and stimulate asset prices, right? And if that's taken away, and if there's no one else actually buying, why would they do that? Because other people weren't in a situation to buy it. Once they started to move that cash around, capital around, well, other people started to, buy, and that had an effect. What happens, unless other people show up keep to keep valuation of the markets up? right, in a quantitative tightening situation, and the people who are buying were the Feds, and they're not there, what happens to the market? Again, I mean, that's maybe a little bit more speculative, but again, then another macro thing you got to think of. I don't know. I think that this is something I don't see a lot of people kind of think about or say. But again, just an idea to think about, right? If that happens, this is speculation, though. Yeah, it is true, but I think it's a, let's say, a reasonable speculation that uh, not the speculation part that BlackRock was basically running operations for um, the Fed, and I actually have inside info on this. Not from the Fed, from some of my friends who are still, on like the managers and institutional desk and things like that. So yeah, basically, that's really. I mean, the thing I can see is that the market's oversold. Yes, but it's a bear market. You get oversold markets. That's the whole point of a bear market. It's technically been pretty strong, but again, bear market rallies, it happens. Um, right? Let's look at VIX. VIX hasn't been acting as well. Now, people would say that, well, that's a sign, but you have to understand that VIX, in other words, that people are not expecting a market downturn. But you have to understand that VIX is something that, it's a IV, right? Implied volatility for the stock market in general. So they're looking at like a month out, right? Um, and so, they might not, if, react to right away. That's because they're looking at a month out. But as they react, they can shoot up high. But the thing is that it's hard to nowadays take VIX seriously in a sense that in the immediate sense, right? And and so you tend to see a lot of like a lot of a situation where the way you would expect VIX to act based off of like before the last 2 years or 3 years or so, they don't. So, and that's the other thing. I mean, with so many people trading options nowadays, it's like you don't have like institutionals just buying options, right? And they say, because then the spreads can go from tight to like, so from wide to tight, and you kind of get a feel for the market. But looking at this tells me that a lot of people are expecting market to be lower in in a month. And um, is that really true though, right? Um, so yeah, so basically, my point is that essentially I don't. This is not really pricing in, right? And it's not really doing its job of pricing in any kind of move or a strong move. And in which case, the dollar is acting more of a true reflection of volatility, and because everyone's moving the dollar because it is the flight to safe, flight to quality, right? It's a safe haven trade. Before I keep on rolling, basically my point is that it's not a good time to put a trade in right now, just because of the date. Also, we have let's look at some of the more important news that are coming out. Two things: GDP numbers are coming out tomorrow. We have GDP numbers, and we have um, PCE numbers, right? What the hell? I thought Michigan. There you go. Okay, there you go. So consumer index is coming out tomorrow. Um, and so if again consumers fail, in other words, that people are not buying, that's not necessarily a good sign. However, that might mean that the Fed will start to think about tapering. Um, right. So that's the two big numbers that are coming out. And again, if the GDP is lower, again, than expected and likely to be in the negative, um, technically we'll be in a bear market, in a recession, and Usually when that happens, market tends to, you know, stay down, right? Um, yeah, and so also, and the other thing is that as much as the market has gone down, right? Um, you're likely to usually, if the first half of the year is so bad, usually the second half is pretty good. However, you have, you know, the GDP numbers, underperform. Um, and at the end of the year, you have bad GDP numbers. Let's say like we have recession, we have higher interest rates, we have weaker market internals, home prices, housing is starting to give way. Housing gives ways. Guess what? It's gonna go into everywhere else, and the producer's gonna go down. Their business is gonna go down, right? Orders are down. Employment is gonna be even lower. I mean, yeah, I mean, unemployment is gonna be higher. So basically, all of that combined is this week is very important for all these reasons. But all those are basic reasons to kind of, in my opinion, again, it's not an advice, recommendation or anything. It's just, a trader's idea of what's happening. This is still a bearish market. Now, intraday, you can trade any way you want, right? I mean, especially this, and this also another way you can kind of, another indication this might be still a bear market is because how violent these trades are, right? SPX goes down like, intraday they're really hard, and but then they don't really break anything. They don't break any kind of important level. Like they broke this, the 39.20 level or whatever. It was very important early on. They did, right? But again, these trade in the big picture, they're kind of going sideways. Intraday, though, they're going really hard, one or the other, and they will turn around also very hard, but they don't really break anything, right? So anyway, yeah, you know, uh, still a bearish market. You might see some kind of a extension. Now, technically speaking, if it keeps on moving up, then I have to be ready to take the opposite side of the trade. If it breaks 41.75 with strength, well, I mean, can't argue with the market. Then we have 43.05 or so, then this level, right? But really, the next big level is this. This is the really strong level. If this level is taken out, right? This is the two shoulders. So um, yeah, but right now, the market is in the short term in an uptrend, but really it's going sideways. It has to break this level for it to be in an uptrend because still within this range. Um, it's like somewhat of a pennant. Like in the big picture, like on the hourly, you can see a pennant forming. Also daily, you can see a pennant forming on the dailies, right? So on a downtrending market, and if you have a pennant, usually those are trying to draw it with the left hand. Those are um, continuation patterns, right? Now, one good thing about this pennant is that it's hitting this high now. Again, if it stays and breaks it with good strength, let's see what happens. Um, Yeah, before I let go, before I keep on mumbling and whatever, leave it off right now. But yeah, I think again it's still a bearish market. Let's see what the Fed says. Let's see what numbers come out. Basically, GDP, inflation rate, and unemployment rate is what we are looking at. Did I look over the jobless reports and stuff that's coming out? Earnings are, I mean, there's too many stocks, but earnings are like the big names are, this is the time of the year that you're gonna, or the we're gonna get a lot of the big companies coming up with their earnings. Um, what was I gonna see? Okay, initial jobless claims will be coming out tomorrow. So jobless claims and some of the job numbers. So again, they're gonna be looking at that. So this all feeds into what our expectation for the next leg. So anyway, I don't want to keep on going over and over. And I should leave. Oh yeah. You know what? Last thing. Last thing. Um, you have Meta. You have a lot of important numbers. Earnings are going to be coming out. Um, Qualcomm. You got. Let's see. But more importantly, you have to think of like surprises to downside or upside. In a bear market, surprises are usually the downside. Um, if you have surprise to the upside, the market doesn't move, it's a bear market, right? If you have a surprise to the downside, the market moves, well, then it's a bear market, and that's what we saw with uh, Walmart. Let's take a look at Walmart. Man, I say I'm gonna get off this video. I still keep on this video, right? Right there. Gap down really hard. Um, let's see, Pfizer, Tilray, Mastercard. Um, to take a look at the manufacturers to get a feel for overall economic like activity. But again, what matters now is since we're living under a higher uh, uh, interest rate or Fed rate regime, this affects companies' outlook for income. So the income that we're getting now is finally now kind of adjusting for living under that higher interest regime. And so now we have to look at in the future. Then are they lowering the expectation for income in the future, right? Earnings. If that happens, and this is the expectation, right? This is at least my expectation, because you also have to think about like, with the dollar getting stronger, basically foreign business of American companies that that they're going to be making less money because there's simply less dollars because the business they're making overseas in their currency is worth less now because it takes more of that currency to convert to dollars, and therefore those companies make less money. And this is something you see with some of these companies that they're already um, putting out stuff, you know, feelers like to that effect. Uh, okay, so you got ExxonMobil, some of the big ones. I thought Meta was coming out today, or it was Facebook Meta. But anyway, some of the basically we've got to take a look at some of these big names, keep track of it. Um, Walmart again. That's something that's interesting, right? Uh, anyway, yeah. I don't want to keep on talking. CVS. Um, Wayfair is going to be kind of interesting to take a look at. Western Digital will be kind of well, it's just not that important, but it's again a window into maybe what to expect. Um, okay, yeah, I guess I'll just leave it at that before I keep on talking and making it literally an hour. Um, Six Flags, Cardinal Health, New York REITs. Why haven't tried? Walmart, Home Depot. So those are two big ones. So I wonder what's going to happen to Home Depot with housing kind of starting to take a dip. Target, Lowe's. You got the financials that came out this week, the last few weeks, and this is something to take a look at. You got Caterpillar, Deere, and all of them. So anyway, after that, it starts to kind of come down. Basically the number of people um, with their earnings and stuff. So anyway, I guess I'll leave that off for now. And let's see what happens. If you do make a trade, make a trade with when with kind of like I said, this kind of stage, immediate stage, like deleveraging, putting in smaller positions or with hedged positions makes more sense than not, because the market can go either way. Even if it goes up, it could be um, a short squeeze type of situation. If it goes down, well, it goes down, and if it goes up, when we have a true like start of a bull market, and like I said, technically speaking, this doesn't. It's not like what a bull market looks like. Um, like I said, you don't see that capitulation type of um, behavior, right? Um, but let's take a look at. Man, I said I'm gonna. Let's take a look at 2000, 2000. So let's look at 2000. Okay, because that was a very interesting time. All right, so you look at the weeklies, right? If you look at it, you can see that the market goes down like hard, right? Um, but then again, they would do these like, let's say it went from like um, a high of 1530. This is you know middle of '01. It went down to 1085, then did a bounce move up 1317. That's almost 50%, right? We haven't had any kind of move like that. We have these kinds of moves. Then it went down again 948 from 1320, and this, right? Um, 915, 957 again, another 50% retracement, almost 50%, 1177. And this is basically what like kind of capitulation kind of looks like, right? So it went down hard and it stayed down again hard again. In other words, it stays a negative situation and the trend keeps on just, staying there and keeps on like spiking, right? And it can't get out of it. It did it again and then it started to slowly get up. But look at these are by the way weeklies. Look at like the intraday weekly, right? As it's moving up, it gets slow, like small amount. It just, kind of like peppers small amount of up move, right? Um, and this is what a washout or capitulation type of move happens. 2008 again, right? You have a basing period here at the bottom. All of a sudden, it kind of just drops down. Boom, moves up again. Actually, the space is again over here, but look at the moves, right? It consolidates, and the consolidation is smaller. There's not a lot of like volatility inside, which is different than what we have today, right? It's not. We don't have any kind of basing. I mean, you can see the ranges are still big. So again, this is not a. If you have a bear market, this doesn't look like a capitulation point, basically. Um, and capitulations usually happen like you know after you have a lower base, which takes some time. It's definitely not a 1 or 2 week thing like over here. And then capitulation. If this was a capitulation move, it should have happened from here, the low end, not from the top, from the intermediate high end, right? And then it goes down, spikes down, goes up, and then once it goes up, it kind of stays and kind of it doesn't really range as much. You know, bases with less volatility. um, like here, right? With these kinds of inner week or intraday moves, basically, it keeps on going up. But if you look over here, the ranges are all over the, it's really high. So again, this tells you that there's still a lot of activity, a lot of demand, one or the other, that's present. And the people at the lower, at the low of the market, we haven't exhausted the number of people who are still buyers. That happens again when you're at the low end of a market. You just, that's why the ranges get smaller, because there's simply not enough buyers to push the market up. So anyway, I think I should stop it now before I keep on going. So with that said, good luck everyone, and happy trading. Like I said, if it does move up, there's going to be ample opportunity. It still needs to prove itself if it goes up before anyone can start putting it, or it makes reasonable sense to start putting on big positions. And till that point, it's still in a bear market. Again, that's IMO, my opinion. And till that day happens, again, it's still a bear market. And one should, proceed cautiously. And yeah, if it does go up, like I said, these are the levels to look at. This is going to be important level 4164. This area is for 4320. What is it? 4305, I thought. 4305. This is a intermediate, it's not as strong, 4507, but this is really the strong level here, which is 40. Let's just say it's you know, technically speaking, you have to be here, 4636. But really, I mean, 46 and above is like, basically that range is a good area to look at. Um, all right, so that's the upside. If it's to the downside, again, we kind of go back to, and also this general trend. Again, this is a it's not a pretty pattern of any kind, really. You could say um it's on the hourly. I mean, this is a like a really bad pennant pattern, so it's not like the most clean pattern. But these are again usual continuation pattern. If the one daily, is the downside, and you see this kind of pattern, we would expect, well, the market to start going downside. Again, not the most pretty pattern, to be honest. Um, right. We don't have two highs here to connect that into any kind of pattern here. So anyway, I will leave you with this. We're entering also the volatile time of the period of the market, with all these things as a headwind, and with the most volatile period of the market in front of us. Again, that doesn't bode well for the market, at least reason would say. But again, market has proven people wrong all the time. Um, but yeah, either way, I hope you good luck with your trading. By the way, if it does move down, watch to break this trend line here, or to go in a sideways pattern. If it goes sideways pattern, again, ideally you want the market to prove itself. There'll be ample opportunity to put a position in. If it does break this lower support level and breaks down, then that will be a signal to get in. All right. So that's it. Hope everyone good luck and happy trading.